Welcome to another riveting edition of Risk and Return. I'm Charlie Gasparino. I just want everybody to know I'm here at the worldwide headquarters, here at the chairman's table of S3 Partners with Bob Sloan, the founder and the CEO of S3, the best data provider in the country, in the world. I'm not just saying that because they cut me a check. I'm saying that because we get real-time information from people who swear by this stuff. In any event, I want to get to that immediately with Bobby's, like, you don't know this, but he's right by my side looking at me weirdly right now because it's so odd. We're usually in two different rooms. So
we've done 25 shows.
I know,
on our laptops virtually, and we're preparing to do a live show. Hopefully next week.
This is like a run on this, right?
Well, we'll do it. We'll do
dry
run in this setup, and then next week we'll do it live.
Right. So that means if we're live and I say something stupid, we get in trouble, right?
Well, we don't necessarily get in trouble.
The lawyers don't come in.
But we don't.
It's always a possibility with me.
I
know.
I mean, the worst thing is that we become really famous for like 30 seconds,
or we get sued.
Our lives.
But anyway, we won't go there. We're not going to get sued. This is a show about information, about making you money, right? If you're the on the other side of the camera here, and helping people understand the economy. And we're going to talk a little bit about the economy because Jerome Powell threw a curveball at Donald Trump. I would say a fastball. What am I saying? Curveball. It's a fastball at his head. I mean, knowing that Trump wants him to keep cutting. He did cut this week on Wednesday. He may never cut again until he's out of office. He's literally signaling we have stagflation. He's literally signaling that we both have some troubles on the job market, and you read it every day. There's job cuts going left and right. Wall Street kind of likes that. So for your investments, it's kind of a good thing. But also we have an uptick in inflation, possibly because of tariffs. So we'll get into that a little bit later. First, we're going to get into your actionable ideas because we got a lot of good stuff. Even an ETF that for some reason I never heard of, investing in meme stocks. Now, it went under, what was it called? The Rosedale?
Roundhill.
Roundhill. It shows you I never heard of it. This Roundhill ETF, which is fascinating to me because it initially invested in AMC and GME. It went belly up at the end of 2023.
That's right.
For obvious reasons, the meme stocks imploded. GME didn't quite implode, but it's way off its highs, right? That's GameStop. Probably the best of all the memes. All the other ones just kind of got crushed. AMC is trading at something like $22.80, which when you factor in the reverse split is actually 28 cents. It just shows you how much people got crushed on that stock.
That's right.
But anyway, this thing is being reinvented by throwing AI in there.
AI and quantum computing. We'll go over the constituency. We'll go over the short interest. And it just came out about 10 days ago at about $8.50.
Is there still meme in there?
Well, it depends what your definition of a meme is.
I mean, is GME still representing in there?
That's the point. The point is that the constituency is totally different.
Now it's just AI.
It's just AI and quantum.
Oh, that's interesting.
Quantum computing stocks.
This might be a market top for AI.
The top of the market is when the last short sale is covered,
right,
and the long isn't buying anymore, right? So right. These things do tend to signify tops and bottoms. And this is why we're going to talk about it.
Okay. You're going to start with some other stuff first.
Yeah,
right?
We're going to start with some other stuff. So this week's picks. Now, mind you, we're going to make sure that people out there understand. When we say, let's say, last week we had two picks. One was Ford. One was the railroad company. And Ford was up about 12%.
Right.
And we said, hey, these things are coming out on Thursday. Our show drops on Friday morning. We got some comments that said, hey, it's easy to go and backward looking and pick these stocks. We're not doing that. Yeah. we're not doing that. Okay. So we're not. I mean, listen, we're not doing that.
This is real time as we
do this.
And it's not necessarily just for people to trade off. It's to understand the data that S3 provides. And because you'll get a deeper dive when you get the data real time.
That's right.
You know, and go onto your website and do it. What you have to do to get that data.
No, that's exactly right, Charlie. So we're going to do a couple different things
Right.
this week. We have Cigna Healthcare, which is obviously an insurance company. It publishes this Thursday AM. We think that stock is going to go up. And we also have Thursday AM.
What's their stock symbol, by the way? Do we have it?
Cigna is, I think it's CIGM.
CIGM. Okay.
And then Bristol Myers BM is, we think that'll go down, both releasing Thursday morning. So those are our two picks. The picks over the last 3 weeks now that we're in earnings season, in aggregate, up about 12%.
Oh, interesting.
So we're doing pretty good this earnings season. And, as markets stabilize, the signals get stronger, get more volatility. It's hard to actually do. But, we've been in a pretty good trough right now, meaning.
Unpack both of those if you can a little bit.
Sure. So if you data series and prediction, if things are within a certain volatility band, you're going to get a stronger signal. If things are moving all over the place, depending on the market cap size of the company, you're going to get a lot of noise. And separating those two things, the signal from the noise, is what we do when we make these picks. And so right now, we feel like we're in a pretty good zone for us to be even more accurate than usual.
That's interesting. So give us the backstory on Bristol Myers. Why are you, that's a short?
Yeah. So what we're looking for is the relationship between short interest and the active longs as we parse them. And one of the things that we've always said on this show is that data that comes to you can be a proxy for something else. It can be latent, meaning it's late, or it's just misclassified. And 13F, when people look at holdings and they say, when Warren Buffett's doing something, or whatever, some other famous investor is doing something, you have to be very careful, because what you really care about is how much is being traded in that stock over, let's say, the next 60 to 90 days.
13F, how real time is that?
It's not.
That's one of the problems.
It's delayed 45 days.
That's what I'm saying. I didn't know the exact day, but
it's 45.
It is a lag here.
Sure, and that's done to protect the people if they want to accumulate a position in the stock that's not a control position but a significant position. And a control position, they have to file. Someone like a Buffett, they do need that protection. It's not a favor. It's actually, I think, a good thing for the market to do that. However, in today's age, the government can actually have something like an Oracle, where there's a point-in-time system where you should be able to get economic statistics real time, or at least pretty close to real time, which is what we do.
But why does Buffett need protection on that 45 days? I mean, why? So they don't trade around him. They trade ahead of him, screw him up if he's going.
That's right.
If he's going to build a big position.
That's right.
Okay.
And the longer term, if you think about it, it works for the investors. If someone like a Buffett that does really have that patina when he puts his imprimatur on something, you look at one of the great trades of all time, the Japanese trading houses, right, that he did this year.
Interesting.
Unbelievable. The stock market was, I think, 27,000. The Nikkei is 27,000. It's now, 40 plus thousand. The stocks have gone ballistic. It was one of the few times he's invested outside the United States, and he got it really, really, really right. However, interesting enough, when you look at Berkshire Hathaway, the stock is kind of falling, and the question is why. And I'm not going to answer that because I don't know why, but it's falling.
It's a weird sort of divergence, because it reminds me a little bit of why gold, the physical asset, soared, and why, as you pointed out a few weeks ago, the ETF started a crater weirdly, and we were like, well, what the hell is this? Shouldn't it really go in tandem? And sometimes that signals something. As you know, gold is way off its highs,
as we talked about,
and maybe the Japanese stock market is going to get a little reckoning here.
Well, depending on the tariff deal, and I think that's a good segue.
Although Buffett is in many different stocks, not just this.
Well, he's also 90 years old or 92 years old, and maybe that's what the market is saying.
That's a good point.
Can anybody be that person for long?
Amazing guy. I mean, even though if you don't like his politics, remember, he's been very progressive. He's just, you can't take this away from him. This is amazing stuff.
Greatest business, greatest investment mind of all time.
Of all time.
That's not an exaggeration, right? I mean, it's incredible.
It's just it's mind-boggling. And to call those Japanese market to me is really amazing. But go on. You got some other picks.
Yeah. So the one of the things that we saw, and maybe we can just rearrange the order here on the fly, is if you look at the Russell 1000, you look at the way hedge funds are positioning. It's very interesting. In that stock, in April, you saw the market take a dump,
right?
Because of all the tariff shock, let's call it that. People got very defensive. They de-risked, right? Market was down 20%. Now they're down. Markets rallied like crazy. And what's happening along the way, as you see, is that the ratio between long and short, active long and short interest, people are still adding risk, but they're adding risk very cautiously. So they got caught offside. Now they got to try to catch up. The return is isolated in 10 stocks. And so you see shorting increasing, but longs increasing too. So it's a very cautious way to keep chasing this return.
And who are these 10 stocks?
Well, it's the Magnificent 7 plus,
right.
A couple others, right?
So, and throw NVIDIA in there too.
NVIDIA, the 7 stocks we all talk about, maybe throwing,
Amazon,
IonQ, et cetera, et cetera. So you throw in a couple AI stocks on top of that. You almost definitionally, if you've kept your exposure down, you were going to trail. Now the market rallies, and you're trying to keep pace, but they're keeping pace in a very cautious way.
It's interesting because NVIDIA's market cap now, before Powell's
$5 trillion stock.
Yeah, before Powell came out. So who knows? Maybe it corrected underneath there, but it hit a $5 trillion market cap. That is amazing.
It's amazing.
Yeah.
I mean, you think about it, that one stock is bigger than almost any economy in the world.
Yes.
Almost. I think it's bigger than Germany.
Now, Germany's got to have it. I mean, the EU economy is about 20 trillion, right?
Trillion, but I'm just saying the individual company in Germany, I think it might be 5 trillion.
Oh, interesting. Okay.
Or 6 trillion. Something like that. It's pretty close. Don't quote me on that. So but it just shows you how gigantically large this company has been. And then you have stocks
or inflated.
Well, that's the point. And one of the things that I saw was an interesting tweet by Jim Chanos. He put up a forecast of power prices by energy. It was fairly flat. So you kind of think to yourself, wait a minute, energy is obviously related to the grid and production of energy and so on. How could it be flat? It's very counter to the AI narrative. And so it leads to two questions. Is it a supply problem or a demand problem? Meaning AI isn't actually demanding that much energy. That's why it's flat. Or actually we're producing a lot of supply.
Yeah.
And it's keeping it flat.
I remember a couple weeks.
It's a very interesting chart.
We delved into this. Larry McDonald of the Bear Traps report was, we did something on him. We didn't quite believe his thesis that NVIDIA would have to disclose this as an existential risk, this lack of supply of energy to power all the plants. And although it is sort of common sense and it is sort of intuitive, where I disagreed with it is we're going to go into nuclear power. There's no doubt. There's too much. Once you go there, the supply problem is almost taken care of.
Well, if you think about it, what powers the Nimitz?
Nuclear, right?
But it's small.
Okay.
And it's everlasting, and it can go anywhere and do anything.
Right.
And what powers our subs? So the technology exists. The question is, how do you secure it, and what do you do with it? And
Gates,
who owns it, and so on.
Gates is sort of backed off his doomsday call on environment, and we're all going to choke to death on fumes, and we're all going to fry in 30 years because of global warming. And I think one of the reasons why, to be honest with you, he didn't quite say this, is because of nuclear power. He believes that we're going to go there, and he believes the technology is there to make it safer and smaller.
It much safer.
And it's just like a no-brainer, And so I think that's one of the things about Trump that you got to appreciate. I mean, listen, we could talk all day about tariffs and all that, is he is adaptable.
Totally.
And he improvises on the fly. Watch him improvise on nuclear power. I think that's coming. Anyway, I interrupt. I'm sorry.
No, so it's a good segue to talk about tariffs because we've been keeping our eye on battery stocks and energy.
Yeah.
We've been keeping our eye in South Korea on EcoPro, which is a battery company. And, you know, these stocks, the short interest went way up in these stocks. And you can see that the short interest went way up in these stocks. And they were worried about, they're worried about production, supply, et cetera. Right. And there was a really bearish thesis in this particular stock. And we've been tracking this for, the last 5-6 months. You can see in the chart on the screen, you can see how short interest has just gone through the moon, right? So what happened, though, is that
I see it.
Right. And so what happened, though, is anticipating the scarcity of batteries, right? And then all of a sudden, and then the tariff deal happened with South Korea. The Chinese started to cool the demand for BYD, which is their EV. And all of a sudden, the bearish thesis unwound, stock exploded. And you would have seen this coming if you'd been watching our short interest indicator as we talked about.
This is a little counterintuitive to me, just from a fundamental standpoint. If there's a shortage of chips or whatever, these are batteries, right?
Yeah.
Why isn't the stock going up on that?
It did.
Right. Okay. Gotcha.
It did. But what was happening was that, things got overheated. There were a lot of these battery stocks over there, POSCO, LNF, EcoPro. If you look at the short interest in these stocks, you look at the market, the stronger export sentiment, all these things were happening. The short sellers were like, hey, tariffs are here. Here's the counter argument, right? Tariffs are here. There's problems in production. You've got, the EVs, the market is weak. The demand is not going to be there. And it is ramped up. It turned out to be, to your point, all of a sudden there's a tariff deal. All of a sudden people figure out it totally reversed itself. So this was a very big money-making opportunity if you were watching our data.
And you guys caught that.
Yeah, we did.
Okay, that's great.
Over the last 3-4 months. And then there's a really interesting, I think, story going on with Circle, which is the stablecoin company.
Oh yeah,
right.
Sure.
And what's happening there is that there's a huge lockup that's going to come out, and we've seen a lot of shorting coming out because the stock's gone parabolic. I think it's up 5 or 6 times since the IPO, and you've seen there's a lot of stock that's locked up because of the IPO. That lockup is coming off fairly soon, I think in December, early December, and shortage has gone up because they figure the stock's worth $35 billion. Insiders will sell, and you could see some, a pretty hefty decline in the stock once the lockups come off.
And when is that?
In December.
Yep.
And
Interesting.
yeah.
What's the symbol on that one? So we should keep an eye on that.
Circle Internet Group. That's the name of the stock.
Okay. So we should keep a note on that thing. We'll come back to it.
And then I think lastly, we can talk a little bit about this ETF. Which is
say the name again because I forgot.
Yeah.
Rosedale.
It's Roundhill. Meme.
I keep saying Rosedale.
MEME. ETF.
All right, let's give a little background. So this is near and dear to my heart because I always thought the meme stock craze was insane, and
it was insane.
It was stupid, and people, let's face it, lost a ton of money listening to big mouths on Twitter, pronouncing AMC to the moon. AMC right now trades at it's around 30 cents on the dollar when you factor in the fact that the $3 handle on the stock is the result of a 10-for-1 reverse split. GME is way off its highs. I mean, it's in the $20 range or something. I don't even know. I stopped covering it because it doesn't matter anymore.
Because it doesn't matter anymore.
I mean, it's
exactly
just,
right.
So people got crushed on these stocks, right? That Roundhill put an ETF trying to capitalize on the meme stock craze. It didn't work out. It liquidated at the end of 2023. It is now back trying to capitalize, I guess, on AI.
Yeah. And so you look at some of the constituencies. You have Well, hymns is a kind of interesting one, but most of them are applied.
Hims is
Considered a meme stock in this ETF, right? But most of these are IonQ, which we've talked about on this show quite a
Right.
bit. Applied Blockchain Inc. We've talked about that a lot. We talked about Rigetti Computing. We've talked about that on this show. We've talked about Open Door Technology, more AI. We've talked about Navitas on this show a lot. We talked about Quantum Computing Inc. So you get the idea.
Is GME is not in this?
No, there's not at all.
That's interesting because GME has still got some fluff in it, right?
Now, the only thing that's
AMC
probably
obviously is not.
They're not. But the only thing that's left over from the meme stock craze is Krispy Kreme donuts. Krispy Kreme donuts. That's what's left.
Where are they trading at these days?
I don't know.
Pennies
I
on
mean,
the
but what's interesting is that now here's what's interesting about all
Let me
these
just
stocks.
do
No,
the
check it
old
out.
Google. Yeah,
So
go
here's
ahead. While
what's
you're doing that,
Yeah, but I'll run down some of the short interest as a percentage of float, and we're going to get to something that happened between me and Grok on X this week.
you had a fight with Grok.
No, I didn't get into a fight with Grok. I think it's very interesting what happened with Grok.
Krispy Kreme is a penny stock. It's
yeah.
trading at $3.79.
Okay.
As
So
of
anything
today.
below $5
is a penny stock.
Is a penny stock. So what's interesting is that if you look at, for example, IonQ, 14% of float, Applied Blockchain, 34% of float, Rigetti, 14% of float, D-Wave Quantum is 13% of float. Then you have Cipher Mining, which is kind of a AI related thing because it's a minerals thing. It's 20% of float. Open Door, 26% of float. We have Navitas Semiconductor Corp, also 26% of float. And then Quantum Computing is 2%. Big Bear AI also is 18%. That's been on our radar screen. So all these stocks have a pretty high, fairly high short interest as a percentage of float. But we got into a bit of an argument Beyond Meat, which we talked about last week.
You know, my inbox is getting flooded with this. Is there a short squeeze in this or not? Because people are saying there is, there isn't.
What's happened is that, and this is why this show exists,
Right?
because market mechanics can be very complicated.
I know.
And we were talking with Mark Elovitz, who's one of the deans of regulatory. If you're an investment manager, he's one of the guys you go to figure out how things actually work and what you can and cannot do. It is crazy to me because you mentioned a bunch of stocks that got diluted. We talked about one in Hong Kong. Dongfang got diluted.
Right.
Retail comes in. The idea of dilution being released into the marketplace
Negates a short squeeze.
It can, right?
Well, it should.
It
is the
can.
stock eminently? I used to have
It can.
I used to have conversations just so we go back. What is a short squeeze? Short squeeze is when the shorts can't cover because there's no borrow. They can't borrow for something because a short sale, as you know, is you borrow the stock, you sell it, you replace the borrow, hopefully when it goes down. So when you can't borrow it, the stock goes up parabolically. But
you can have a situation, Charlie, and that's true. That is all.
Right.
All what you said is very true. I would just add a little sprinkle on top, which is it can be borrowable, but if the shorts are losing a ton of money, that's also a squeeze too. So it's not so much the supply; it's the amount of money being lost that really is the extra kicker to define what a squeeze is.
And it also depends on your position. I mean, are you heavy? I mean, if you're like, what was it, Melvin Capital, right? Was it Melvin?
Know it well.
They were involved in a short squeeze where they couldn't really cover. They had to cover. One of the things that after that situation, the apes and the retail, they really thought that they could squeeze every stock because hedge funds were heavily shorted this. Now, hedge funds weren't heavily shorted. And I used to go back to Jim Chanos, the great shorts. He was a short seller, as you know, the most famous. And I would say, AMC is up like 30% this week, because there would be periodic pops in the stock. Tremendous. Is this squeezing? Because they're saying it's squeezing. Goes, this is the apes just jerking off. It's eminently borrowable, and people have positions trading around it. And that's what happened. The street got really, really smart to the retail, the way it played. It played retail. So it would trade around. It would go actually long on these stocks, trading off the apes, keep a short position where they didn't have to cover because it's still borrowable and people weren't demanding, and they would just meet their margin. And then when the jerk off ended, so to speak, I'm using vernacular here, they might cash out. The stock falls and their short is essentially in the money.
The borrow is certainly one element to it. The cost of keeping the current borrow is another element to it. Whether or not the community of short sellers is down money, to me, that's the biggest thing, because no one covers a short if they're making money.
Yeah.
Right. If they're making money,
supposed to make money on their long, and they've hedged the position.
Well, then they would keep it, right?
That's what I'm saying. That's what they're doing now.
Right. So that
that is kind of the thing. That is kind of the tactic that I see in the hedge funds doing that.
No one takes, I think, to talk about Melvin, no one, what happened after that is that the way people short changed.
Yes,
dramatically. And this idea that you would have a 4 or 5 or 6% concentration in one particular stock short in your portfolio, it may exist, but nowhere near to the extent that it did, 5 years ago or 4 years ago. But what's fascinating about this ETF basket is that it's revived the meme, but populated with AI and quantum stocks. And then, Beyond is in there. And last week we talked about this and said, hey, the stock went from like 3 to 8 back to, or 6 to 8 back to 6. Now it's down up 3. For a while, when the stock was going parabolic those 3 or 4 days, and short sellers had some gains, wiped it all out. Bar cost was really high.
Okay.
Then they did this debt for equity. They did a swap, or they did a convert rather. And, you had about $300 million worth of stock that came out into the marketplace. That got released, I think, on October 17th. Now, believe it or not, when that happens, depending on the information provider you use,
right,
you can get different numbers. That's why we were one of the people on X talking about, actually, there's no such thing as short interest of percentage of float being over 100%. You have the amount of outstanding shares. You add in what's been bought off the short sale. That is what the actual float. And people confuse outstanding shares, outstanding amount, with what's tradable all the time. So what happened in Beyond is that they got into, on X, the mechanics of how stock is released through DTC, which is a clearing mechanism for the marketplace, and released into the marketplace. And I said, oh, well, there's all these different rules. And it's all bullshit. It was very simple. The stock got released on the 17th.
So there was no short squeeze.
There was no short squeeze, but there was for, I would say, 3 days.
Nothing existential.
Nothing existential. But this was all over the place.
Well, because people think they're living in 2020 still.
That's right. And so there was another data provider out there, a one that serves that community, which is, we do not deal with a lot of retail folks at all. And they were just wrong. They had the float totally wrong. So I went on X and said, no, this is incorrect. The real number is 9 to 10%. Shortest float, which is what it is today.
Right.
That's totally wrong. And someone asked Grok what the short interest is, and I saw it. And then I asked Grok, and I said, no, Grok, you're wrong. And I put it on my feed.
Did Grok answer you back?
Yeah.
Oh, that's amazing.
Now, here's what happened. This is where it gets kind of interesting. So it answers me back, and I just said, no, that's incorrect. Your methodology is wrong. Because you are quoting... You have a statistical opinion on something that you see in your universe. That is not correct. This is correct. But it was interesting, in about 5 interactions, it actually found our white paper, did the calculation, said, actually, you are correct. So I said to Grok, why don't we do what?
This is AI correcting itself.
It's correct.
Based on
you
your
conversation. I posted it, so you can look at it all
That's
happening.
Like scary and interesting.
I posted it. It was all happening.
Right.
And I said to Grok, well, why don't we do a webinar on this? S3 and Grok.
So you're going to do it?
So this is where it gets interesting. Great idea. I said, has it ever been done? Grok says no. So it's a first in the world. I said, great. What date do you want to do
You're
it?
making history here.
I think so. And so they said November 12th, 2 p.m. Great. We're in. DM in your mail, in your inbox. No DM comes. We're waiting. No DM comes.
Grok is screwing you over.
2 days later. Hey, Grok. And so we did get this email saying, well, it's in a queue. It's this, it's that. So I think what happened is the bot's been trained to agree, not necessarily with the analysis, but to service a client asking for help. It says DM in your mailbox, no matter what it is, even though the analysis was correct. So it shows you that don't be so reliant on AI.
So that gets me to this ETF and everything else.
It's a very interesting thing. And by the way, Elon Musk, if you're cluing in, we'll show up at 2 p.m. on November the 12th. We will be there, just like we're here every week talking about this stuff. There's no one better in the world at it than we are. We're happy to do it.
Maybe there's a bubble, and it's because literally the whole market is trading up on AI right now. I know people talk about the interest rates. I mean, I think the whole market's trading up. That is a little sprinkles on the top.
Hyperscaling and CapEx and investment, and that is
in AI.
Now, you remember a guy.
Yeah,
I know you do, because people out there should know one thing about Charlie Gasparino. He knows his journalistic history. He knows his chops, and he knows his peeps. Does. And he knows all. No, but fuck being old. That's bullshit. I mean, seriously, you are a student of markets.
Yes.
You're a student of people that have written about markets, and you know them.
Right.
There was a guy by the name of Jack Willoughby. He was a senior editor.
Jack's a good friend of mine.
Okay. Right. How did 2000
burn rates?
Thank you.
Never forget that story.
There you go.
He wrote a story about how they were burning through cash. Right. And he basically said this internet bubble this is like, I would say 3 months before the whole thing blew up. It was at highs. Henry Blodgett was then an analyst from Merrill Lynch, still touting stocks. Mary Meeker was at Morgan Stanley saying how great it was. Go up. Jack Rubin was pushing the telecom stuff. And here was Jack Willoughby, this bespectacled guy. By the way,
bow tie,
black belt in judo. You should know. Not a guy you.
No, he's not a softie. No, he was not a softie.
Jack, he's from Canada too. That's funny. But Jack came out, and we should have him on our show. We should have him as a guest.
Should call him right now
and call him. We'll call him after the show. But he said, listen, all these top internet companies that have these wicked valuations, they're burning through cash. Here are the burn rates. These are basically saying these are the stocks you should be shorting now, because they're gonna implode. And lo and behold, they did. He literally called the internet.
Literally called it
bubble bursting.
Right. So, going back to present day, I just found it really interesting that we had asked Grok, and by the way, I do think Grok is it was pretty impressive what it did. Because it took bad information, and it was bad, and said, we're going to recognize that what you're saying actually does make sense.
But that shows you it's a work in progress. Totally. It shouldn't be. It's not God.
No.
And I think that's where I think there's going to be a correction here. I'm not saying a correction in the markets. I'm saying there's going to be a correction in people's faith in all things AI. And I think that, and when you get like ETFs like this, it always makes me think of market tops, but maybe, listen, that's my history speaking, some kid might come in and says, oh no, you're a boomer. You don't know what you're talking about. What's the difference between two extremes? There's virtue, right? You ever hear that? I think it was Aristotle said it, right?
Right.
So my point is, you and I have a certain mindset about markets. The kids who have never really experienced a down market have another mindset. Somewhere in between is where they're going to meet. I will say this, though. The kids having the mindset thought AMC was going to 1,000. It is trading at 30 cents right now based on, following factoring in the 10 for 1 split. People like you and I saw that coming 10 miles away.
10 miles away. 100%.
And so we'll see. We'll see who's right. So that's your calls for the week.
Let's get to Gaspo's headlines.
Okay, my headlines. I've never wore a tie like that. Plus, the guy that makes me look like I'm some sort of wimp with small arms. I work out every day. I mean, change that graphic. Anyway, we'll get on that after the show. What are my headlines? My safe word, Elizabeth Warren. I'm like, I can't help myself. So CZ, Changpeng Zhao, known as CZ, the founder of Binance, he's still the largest shareholder, by the way. He's worth $80 billion. He went to jail for 4 months, not for money laundering, but for a violation of the Bank Secrecy Act that he didn't, as CEO of Binance, put it in proper control so other people didn't do bad stuff.
Right.
He did go to jail for 4 months. Trump just pardoned him. I broke the story that it was coming. And what I did early in the week was break the story that over this pardon and the attacks from Elizabeth Warren, CZ essentially wrote Warren a demand letter saying you need to retract what you put on X about me, or else I'm suing you for defamation. And so what she say about him? She said that it's horrible that I'm paraphrasing a little bit. You can go to my Twitter feed and my story in the New York Post. It's horrible that Trump pardoned him. This is all about Trump's family. Trump is family businesses very, very much into crypto because you were convicted of money laundering.
So she misunderstood.
He wasn't convicted of money laundering.
Yeah.
He was convicted of the Bank Secrecy Act, not having proper controls. Trump pardoned him, saying, listen, he was over prosecuted. This was part of the Biden administration crackdown on all things crypto. I would say it sounds like a little bit of a harsh sentence for a guy that ran something and didn't, and it was kind of like a books and records violation. He did fix it. They said fix it, and he did. But they really threw the book at him on this thing.
But that was in the wake of everything else at the time too, right?
Yes,
I mean,
FTX,
freed and everything else, and everything, So,
but they really threw the book at him on this thing.
Yeah.
And there's no doubt that she misstated what he did, and there's no doubt that she was put on notice by his lawyer in real time and asked to retract,
and
she didn't. So now, earlier in the week, she basically introduced a resolution to have the Senate condemn the pardon. It's not going to go anywhere, but she made a big thing out of it. We ran it. We tracked her down and asked her, there are people who think this is defamation. What do you say to that? She basically said, nah, I didn't commit defamation. I said what really happened, but she didn't. And as of now, we're a couple of days in, she still hasn't apologized. I think give it 3 more days. If she doesn't apologize, this guy's suing him. I mean, I spoke with a lawyer, and
for what though? What damages?
Well, that's a good point. Where are the damages? Because everybody kind of knows what's going on, but she is making a big thing out of it. She's going on the Senate floor and misstating. Now, ironically, if you know anything about
how much, right? That's the thing.
But we don't know. I mean, what is the opportunity cost he's missing by her running around saying that he's a money launderer,
right? If its stock price went down, or I don't know, his holdings went down, something, then that's tangible.
Suppose he can't get his job back. I mean, he would like to run
Binance. Harder to prove, but still.
I mean, you see what I'm saying? You don't know the opportunity cost. I just don't understand why she doesn't apologize. Listen, I misstated. I still think it's horrible. He didn't get. I mean, it's literally right there. And then she kind of doubles down on it with this whole Senate floor stuff. Her and Adam Schiff, the California senator, she's a senator from Massachusetts. They're both players on the banking committee. They're both Trump haters, famously. They start doubling down, saying this is about corruption and this and that. So we haven't heard the last of the story. Will she apologize? It would be out of character. I know I would, because you can apologize and you can have your cake and eat it too, so to speak, right?
Totally.
So that's one thing I'm looking at. UBS, more noise about them moving out of Switzerland now and moving to the U.S. Now, the Trump administration is actually courting them to move their headquarters from Zurich to here. Now, why is that? Because, they're complaining, meaning UBS, that, we took over Credit Suisse. We're getting screwed on all their liabilities. I wrote a piece about this, about the various type of liabilities. A Swiss court said they can't write down $15 billion in bonds that they inherited from Credit Suisse because it's illegal somehow. The regulators over there, the Swiss, I guess, equivalent of the Fed,
Yep.
is hitting them with so much capital charges and other regulations. Going to cost them like $26 billion. So earlier this week they applied for a bank charter license with the control of currency, so they could further expand here. They are talking to the Trump people. They're being coy about whether they're actually going to do it, but I talk to people inside that company, and they're making noises like this is going to happen. It would be an insane thing if they did it. Just so that's why I can't say it.
Charlie, but I worked at First
Credit
Boston,
Suisse, right?
Credit
First
Suisse.
Boston.
Credit Suisse, many moons ago.
Right.
But it's hard to actually describe how important a combination of UBS and Credit Suisse is to Switzerland.
Well, that's what I'm saying.
It's like moving NVIDIA out of the United States, maybe even more.
It's more because
it's national. It's really like the national,
right? They have
character.
UBS has Switzerland in its name.
Yeah.
United Bank of Switzerland?
Union Bank of Switzerland.
Union Bank of Switzerland. It's the biggest bank there. And if they merge, I mean, one of the theories is buy a U.S. like mid-sized U.S. bank.
Yeah.
I don't know, whatever's around, U.S. Bank Corp. I
Sure.
don't know, something that's good. They're not impacted by the deposit cap. Like they won't have anywhere. Like J.P. Morgan has a real issue with like growing through acquisition right now because they have this deposit cap. They're at or above 10% of all U.S. deposits. I think they have 2.4 trillion. UBS has a small U.S. bank that has 99 billion of deposits. You can't really go above that 2 point. You can't really go above that 10% without getting wicked waivers from the Fed. I think they went above it a little bit. And correct me if I'm wrong here. When the Fed wanted them to buy, the various regional banks that started like going under, and they were at the deposit cap or near it, so they needed some waivers. But anyway, that's where we are right now. That could happen. Another thing that could happen is, David Zaslav really wants a bidding war for Warner Bros. Discovery. He is the CEO. And these companies, other than the one company that is trying to take it over, almost hostile.
Right.
Skydance, Paramount Skydance, run by the Ellisons, David Ellison, the independent movie producer, and his dad, Larry, who is the world's second richest man at $350 billion, the co-founder of Oracle, and maybe more than that, friends with Trump. So he's not going to have a regulatory issue. I mean, that's how it works now.
Right.
What Zaz is telling people, Comcast, which is interested, Netflix, Amazon, you might not have such a big regulatory issue as well, because we go before the Justice Department's antitrust division, a little less ideological. The staff has some say here. Yes, Trump appointed the chairwoman.
Yeah.
I think it's Gail Slater. I could be wrong.
Right.
But we, there's, and by the way, if you really want this, and these companies kind of need his content, people forget that Warner Brothers has amazing content. Think about the companies it owns. It has top-ranked studio. It's the first studio this year to surpass like $5 billion in revenues. Hit after hit. It has the Harry Potter franchise.
Wow.
It has Game of Thrones. It has HBO. I mean, this is one reason why Ellison's wanted. David Ellison is very tech-forward, believes in AI. You could see them taking that intellectual property that Warner Brothers has and, doing some AI thing with The Sopranos. Right? James Gandolfini coming back to life.
Something like that.
You could see that. I mean, he will play around with that. So that's why he wants it. And I think that's where he's dangling with these other guys. And I think it's a kind of a business proposition. Will Trump really stop Brian Roberts? Well, Trump hates Brian Roberts, right? Because Comcast owns MSNBC. Until recently, they're spinning it off, but still, he's not forgetting that Rachel Maddow has been spending her entire career, a good chunk of her career, attacking Trump, right?
No doubt.
And everybody else. So, Comcast is going to have to play real hardball and go to the DOJ, say, this is not, we got rid of the cable. There's nothing antitrust here. We might go to court over this.
Right.
And they, you never know, they might. And just one thing about Comcast, just so you know, why it's kind of strategically ripe to buy Warner Bros. And bid up for it, bid up above the $23.50 that which is roughly like a 60 billion, 55, $60 billion deal
Yeah.
that Ellison put down. So they're getting rid of the cable properties, right? They're spinning that off. So MSNBC is no longer there. They will have NBC News. They'll have some of their entertainment. They have a kind of a half-ass studio, right? The Universal. It's not great.
Right.
They have cable pipes, and they have
Right.
So that still makes money, but they need programming.
Yeah,
they need this.
They
So-
need the content, as you said. If you have the technology and you have the franchise,
And the pipes and everything, you might be they could make this work. And getting that IP with HBO would be pretty amazing. Like they can get rid of CNN. I don't think he wants CNN, or maybe he does. But if they don't have MSNBC, what's the difference? And they may roll the dice with DOJ, and if they put together a crappy case, go to court.
Right.
By the way, AT&T did that. Trump won. Remember, Trump blocked the Time Warner. Then it was called Time Warner.
That's right.
Time Warner merger with AT&T because he hated Time Warner, hated CNN, said it was too much consolidation. It was kind of a weak antitrust argument. However, they prevailed in court. They probably wish they hadn't, because then they had to spin it out, because it was they didn't know, AT&T did not know how to run a network. But that's where we are right now. So those are my stories for this week. We should also talk about the Fed a little bit. What do you think? Kind of a weird announcement. He ut rates, then he said, don't expect another one. Fastball to the head, curveball at Trump. I don't know. How would you describe it?
It's an interesting thing. To me, there's no doubt that it's how the marketplace will take it. Now, the market sold off today,
Right.
but it seems like the marketplace
Not wickedly,
but not wickedly. Exactly.
Yeah.
So, fine. It just seems like any news, it digests and the market recovers and goes higher. And so that's what I think will happen here.
Okay. I think, listen, it's a little scary what he's saying now. He is saying stagflation. He said, I'm cutting interest rates because I think, we have an economic slowdown. Hiring is slowing. But don't count on it for the future, because I also see some inflation. We're still at 3%. That's stagflation. Like, that's a potential.
10% isn't 10,
But true.
But it's not at their mandated 2. But it's never going to go back to 2, in my opinion, unless something really bad happens.
So we got to get used to 3.
We got to get used to 3.
Well, shouldn't AI make it 2?
Depends,
if it's really
right?
if it's really like good.
Well, you know what? It depends. First of all, we talked about early in the show. We talked about power usage and the expense of that. If that gets higher, yes. If you fire people that that can do that are doing repetitive things,
They're doing that right now. I see that all over the place.
However, it doesn't drive itself. So you have to hire more expensive people to actually monitor the results, and then you have to hire more logistics, because what happens if that dependency?
Yeah, I mean, if
that resiliency needs to be there, and then you have to. So it's not just this. The narrative is AI replaces everything, and there's no cost to the replacement. That's not true.
I heard Sam Altman was talking about robots doing construction work. Listen, Sam Altman is brilliant, a lot smarter than me, knows a lot more about AI than me. Do you really think robots are going to be laying pipe into the ground?
I think robots
in any time soon. I mean, it sounds. He's never been to a construction site. It sounds to me. Trust me.
I don't know what he knows.
Yeah.
He's one of these people that currently are in charge of the future, right? Or at least the narrative.
But he's never been to a construction site.
Well, we don't know that. But we don't know his background. We know his parents did, or his uncles, or something, or his grandmother, whatever.
I think he drove by one once.
Okay, fair. Be interesting to ask him that. Yeah. Have you actually seen something built? Have you built something?
Have you gone to a construction site? I've been going to them since I was a kid. I did construction work when I was a kid. My dad was a construction worker. Thinking about it, there's a little more here than meets the eye, and you kind of need, as you said, those sort of skilled craftsmen to do.
Somebody has to check what's happening. You have to pay those people a lot more, and then the power usage, and then, by the way, the compute usage. So if you use AI and you do something through Snowflake or whatever it is, you're going to pay for computing power. You are.
Yeah,
So,
I mean, is it cheaper to hire a union guy or a robot when you have to all that electricity?
well, that's
and
the
all
point.
that stuff? Yeah,
The analysis is very much one way. And one of the things that's interesting is I saw, I started reading. I think a lot of people are reading 1929 by
Sorkin,
Sorkin.
Andrew, sure.
So, just a question for you: why is media so obsessed at owning the crash?
I'm not reading that book because I know enough about it. There's really nothing in that book that's going to tell me about what's
I'm
happening.
100 pages in. It's well written.
Yeah.
A lot of the sources that he uses were in my book. So, but there's a couple of interesting vignettes of people.
Yeah, I mean,
but it's more. There's nothing brand new.
I mean, there's nothing new in this, and that's what. Like he and I wrote competing books about 2008. He took his book was myopically focused on, and he had the power of the times behind him, so he sold a lot of more books than me. Just full disclosure, I did very well. Made the New York Times bestseller, beat him 1 week. He did like how the people at the center of the government regulatory apparatus were the saviors of Wall Street,
right.
And he got into their machinations over those days as it blew up, and how great Tim Geithner did by flooding the markets with liquidity. How Hank Paulson was puking in his bed and trying to worry about this. This is all. So I had some of that, but I took a step back and I said, how did we get here? How did we get to the point where every bank was sitting on toxic mortgage-backed securities that were priced at 30 cents on the dollar? Right. Now, what were the causes of this? Was it greed? Yeah, there was some degree of greed. What was the government doing? Basically telling every bank you have to make loans to people, using housing policy as a sort of as part of the social safety net, that everybody deserved a home, and we're going to make it very easy for you to do that. And we're going to do that because we're going to employ Fannie and Freddie to buy mortgages from people that may have a heartbeat but no job. And I went back through all the regulatory changes, went back through the use of easy money, and I tried to use all that knowledge and as the chamber music for the machinations of the CEOs and why they did what they did. Right. And you see, I think, and John Mack, who was the CEO of Morgan Stanley and a principal player, said, he always said my book was better. He goes, your book was better. And it was because it really told me why.
Even though
it happened.
Sorkin's book actually made him the savior of Morgan Stanley. It was kind of his narrative, even though they had a 20 to 15 to $20 billion hole in the company.
Listen, John's a friend of mine. He did save it. He did embrace the risk.
Well, he blew it up and then saved it.
Yeah.
But, okay.
He embraced the risk, and then the risk. And one of the reasons why he embraced the risk, and this is what was key, is that he was competing against mega banks, JP Morgan, Citigroup, Bank of America growing at that point. And they were using their balance sheets that were subsidized by the U.S. taxpayer. If you really understand how this worked, Citigroup in particular was buying deals because it can borrow very low because it had deposit insurance.
That's right.
Everybody thought they were too big to fail, which they were. And so when they took, Citigroup almost went under 5 times or 3 or 4 times during this time. But while they took the risk, John had to compete. And I got into all this. And why did he do this? Because the Citigroup was being subsidized because of deposit insurance, which was part of their balance sheet, which covered deposits. And the federal government was never going to allow any institution with $1 trillion in insured deposits go under, because where are you going to get $1 trillion to pay for those deposits with FDIC?
One pool of, at the time, one pool of banks
right.
had deposit base from professional investors. The other had from the public.
Yeah.
And with an implicit guarantee from the government.
And that's what I got into. And I always worry about where these implicit guarantees from the government comes in. And I think that's the problem with this book. I mean, just what little I've read, it's literally regurgitating what it may be in a nice way.
But you have Ray Dalio, and you have a lot of people out there every 5 seconds. The world's coming to an end.
Yeah, but I don't believe
it's just. Listen,
I get
that tells me that actually it probably is not coming to an end.
Larry McDonald called me the other day about
private coming to an end. Everybody says the same
private
thing.
credit.
We know it's coming.
Is this
every conversation?
Is this another Lehman moment? I mean, how many Lehman moments have we had?
Well, but that's the point. Why do you want to call it again? So it seems to me that the book was written in 1929 to bookend Too Big to Fail by owning the entire continuum between 1929 and 2008.
And
that's just, for him, a really smart thing to do.
It's a good marketing move, but
it's a really good marketing
but
move.
It doesn't really advance the debate anywhere close to what we have right now. And I think right now we have a situation where, and this is where publishers, have a hard time. We don't know. What they call them? Known unknowns?
No. Unknown.
It's in that genre right now. We have AI, which could be transformative. And we had a guest, one of your guests made this great point. All the sort of factors of the market that are in conflict right now. AI, tariffs are in conflict. One's inflationary, one's deflationary. One could expand the economy, the other could contract the economy. And we have a lot more. We have technology. We have easy money. We have inflation that's cropping up, but maybe not so bad. And the one thing I will tell you is that, and this is why I it's good to know about the 29 crash. It doesn't do me any good learning about like what everybody thinks about it. With the shoe shine, interviewing all
that stuff,
some dude on the floor of the stock exchange back then, because every crash is different,
right?
And that's where we add value, because we're going to keep you on your toes every week, raising these issues for you to judge for yourself, because we're going to give you the good, the bad, and the ugly. You're not going to get that in a book about the 1929
to be a
stock
crash,
market
though.
crash.
To be a crash, generally there's a vehicle, right? Mortgage backs were a vehicle, right? Tech stocks were a vehicle. Portfolio insurance was a vehicle. Short selling in the 30s was a vehicle. I could go back in time to 1790 when you had senators hiring ships running down the East Coast to buy discounted paper from the states, redeem it as Hamilton was putting. All these things happen. The vehicle's different, but the way the stakeholders actually react, more or less the same.
Well, that's all the same, but that's the easy part. The hard part is finding the catalyst.
That's why I mentioned Jack Willoughby.
Yeah.
Because he was a catalyst.
See, Jack actually called that.
He did.
And, he saw it. Jack, we'll have him on the show. It's harder to see this. I think if you're being honest, take Ray Dalio. I'm not saying Ray Dalio is dishonest. I'm just, all these people, they're all worrywarts, and they're all, listen, they all made one call, and they're.
Well, I'll leave you with this. We can close on this note.
Yeah.
First of all, next week we're going to do something live.
We're going to do it live from here.
As
long as I'm not on deadline.
We're going to do it. We're going to do it live on X. So we'll promote that. But what I'll leave you with is fiber optic cable was an oversupply thing. CapEx right now, you have people spending so much money. That's what's got people thinking, I've seen this movie before. Massive overinvestment trying to capitalize on something that's unclear what it is you're trying to capitalize on.
Now,
and the narratives change.
Now, there was a correction. There was a correction
nervous.
in fiber optic cable, but it did come back.
I understand.
And
by the time they built so much.
The correction killed my friend's company, Global Crossing. And Gary Winnick was a friend of mine. I know him forever. That was kid. Adam Winnick's really smart guy. He's involved in crypto. But it did come back. But there was a correction. He got stuck in that correction. So there's going to be something here.
And that's what that's the unease that I think is coming out with you're hearing this narrative, and there's this kind of burbling of unease.
All right, we're going to leave it at that, at the burbling of unease. Thanks for watching, guys. I'm Charlie Gasparino from Fox Business, the New York Post, with my partner in crime, or non-crime, Bob Sloan of S3 Partners. Catch us next week for a live edition of Risk and Return.